Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first Anthropic's $380 billion valuation and enterprise focus trigger a $285 billion SaaS apocalypse using regulation to build a competitive moat against OpenAI. We'll analyze why this dual strategy is a turning point and how it could affect competitive dynamics in the AI industry. Second, US tech giants seize 70% of Europe's cloud market, leaving local rivals with just 15% despite the EU's digital sovereignty efforts. This discussion will reveal how this infrastructure dominance connects to the larger US-EU tech Cold War and what it means for the future of tech. Third, ByteDance divests its $7 billion gaming empire to a Saudi state-backed fund, marking a major power shift in the global gaming industry. So we'll discuss why this massive acquisition matters and what it means for IP consolidation as state-backed funds reshape the gaming landscape. Fourth, AI disruption fears spark a massive sell-off in real estate stocks, but industry leader CBRE posts record $11.6 billion revenue betting on human expertise. We'll analyse why this investor panic is a turning point and how it highlights the clash between AI's automation threat and its value creation potential. Fifth, GE Aerospace invests $300 million in AI-powered robots that mimic human touch to slash jet engine repair times and solve a global backlog. Today, we'll take a closer look at automating tacit knowledge with AI sensors and its implications for solving critical industrial supply chain bottlenecks. An AI startup just had its value explode to $380 billion. That's after a monster $30 billion funding round, more than doubling its valuation from just a few months ago when it was valued at $183 billion. The company is Anthropic, and it's rapidly gaining an edge over its rivals in the enterprise AI market. Now, you might wonder how that compares to the biggest name in the game, OpenAI, which is valued at a staggering $830 billion. So the thing is, it all comes down to their business models. We're seeing OpenAI leaning into a freemium ad-supported path, while at the same time, Anthropic is taking a completely different path with its premium, ad-free, safety-first approach as a public benefit corporation. Investors seem to be rewarding this enterprise-heavy model, especially with roughly 80% of its revenue coming from corporations. Its secret weapon is a focus on coding with a tool called Claude Code that is winning over developers and businesses. As we discussed a while back, Claude's massive context window lets it take on heavyweight tasks, code migration, ingesting huge code bases, and troubleshooting across entire systems, which maps directly to what enterprises actually pay for. And this secret weapon has a fascinating edge in its head-to-head battle with Microsoft's GitHub Copilot, which is already used in over 80% of large enterprises. So how is Claude Code competing? It's winning by focusing on what businesses value most: security and reliability. One recent study found that while GitHub Copilot could generate code a bit faster, Claude Code was far more methodical and effective at flagging critical security vulnerabilities. For a major corporation, preventing one single security breach is worth far more than saving a few seconds of a developer's time. That's the edge getting businesses to switch. The numbers are staggering. Anthropic is now on a $14 billion annual revenue run rate. Revenue from Claude Code alone has more than doubled since the beginning of the year, hitting an annual run rate of over $2.5 billion. Remember when we noted how some companies were consolidating a sprawling stack of third-party SaaS tools into AI-first workflows? These run rate numbers are the tangible follow-through on that early signal. But that's not the whole picture. The real turning point is how each new Anthropic launch is sparking a brutal sell-off in global software stocks, forcing another round of repricing for legacy software. We previously analysed that earlier Software-mageddon wave, the so-called SaaS apocalypse. And this isn't a one-off panic. And when we say brutal, we mean it. After Anthropic announced its new AI agent for legal work, the stock for software giant Thomson Reuters suffered its largest single-day loss in its history, plummeting 18%. The total damage across the software sector was estimated at $285 billion in lost market value. As we said a while back, this isn't just about one company or just US. Names the core fear we flagged then is now center stage. AI agents that can tackle end-to-end tasks are being treated as direct replacements for entire software platforms. Anthropic is also taking a completely different approach to regulation, donating $20 million to back US political candidates who support regulating the AI industry. Now, get this, it's a brilliant and controversial strategy. This decision brings the clear benefit of positioning Anthropic as the responsible, ethical player, but it also comes with the inherent risk of being seen as building a defensive moat. By helping to write the rules, Anthropic can push for regulations that favour its safety-first approach, potentially disadvantaging faster competitors. It's a way to use regulation itself as a competitive weapon, intensifying the ideological battle over control versus permissionless innovation. Their official statement says it all. The companies building AI have a responsibility to help ensure the technology serves the public good, not just their own interests. This isn't just a funding story. Backed by giants like Google, Amazon, Microsoft, and Nvidia, Anthropic is waging a strategic assault on the AI market, combining aggressive product disruption with a push for regulation to rewrite the playbook for how to build an AI empire. Speaking of American tech giants rewriting the rules, their influence isn't just in AI, it's reshaping entire continents. And that brings us to our next story, where the battleground is the very infrastructure of Europe's internet. A while back, we called this a budding tech Cold War between Brussels and Washington. Today, the numbers show where the real battle is. Let's start with a single statistic that might just change your entire perspective on this situation. 3 American companies now control over 70% of Europe's entire cloud market. The top 2 European competitors, they have just 2%. Each behind those numbers is a story of sheer economies of scale. The US cloud providers, the hyperscalers, built their dominance through tens of billions of euros in investments that European companies simply haven't matched. To put it in perspective, while the European cloud market grew 6-fold since 2017, local providers only tripled their revenue, causing their market share to plummet from nearly 30% down to just 15%. We previously analysed how Europe is trying to claw back control with regulatory firepower under the Digital Markets Act, but the latest development is brutal. Rules can open interfaces, they can't manufacture scale. When we place Europe's ambition for digital sovereignty alongside the hard reality of its dependence, the contradiction becomes clear. This isn't just a market lead, it's a market lockdown. Amazon, Microsoft, and Google are not just winning. They're cementing a digital empire on a continent trying to declare its independence. You can pry open a messaging API. You can't regulate your way into decades of CapEx and cloud footprint overnight. This is where the situation takes a more complex turn. According to market analysts, European cloud providers have been steadily losing ground for the last 9 years. One chief analyst put it bluntly, saying it will be incredibly difficult for European cloud providers to meaningfully reverse the market share trend. He says if you could go back 10 years, European companies should have tried to become major players, but they didn't. The strategic conservatism of major European tech giants like Germany's SAP and Deutsche Telekom meant they effectively missed the starting gun. Back when Amazon launched its cloud services in 2006, these established companies were focused on protecting their existing business models. And when Washington labelled Brussels' tougher stance discriminatory, Europe doubled down. One senior official even said they would defend, implement, and enforce our rules to defend our market. The will is there. The infrastructure isn't. The dominance doesn't stop at the cloud. In the critical enterprise software market, US firms hold at least 59%. Giants like Oracle and Microsoft are deeply embedded in the continent's corporate infrastructure. Even the CEO of SAP, Germany's software champion, acknowledges the fight, stating leaders are now looking at technology as a way to gain sovereignty over both data and software. Interestingly enough, this all points to a legal and political minefield. The issue boils down to a direct conflict between Europe's GDPR and the American Cloud Act. The Cloud Act gives US law enforcement the power to demand data from American tech companies, no matter where that data is stored. This creates a legal paradox for European businesses, as complying with a US warrant could mean breaking Europe's strict privacy laws. This isn't theoretical. It was at the heart of the landmark Schrems II case, where Europe's highest court invalidated a data sharing agreement with the US, precisely because of these surveillance concerns. Despite the political drive for independence, the data shows a continent not breaking free, but becoming more deeply entangled. The quest for European digital sovereignty is being dwarfed by the reality of American market domination. we were just talking about the geopolitical tensions in technology between the US and Europe. Now, let's shift our focus to another major power play, this time in the global gaming world, involving China and Saudi Arabia. The story begins with a decision that caught everyone by surprise. The company behind TikTok is making a bombshell move, preparing to dump its blockbuster gaming division in a deal that could be worth up to $7 billion. This is a complete 180 from a company that once sought to conquer the gaming world. Actually, this kind of pivot is becoming a pattern for tech giants. Remember Google Stadia? It's shut down. Amazon has struggled to find a major hit. After all, building a sustainable gaming empire is incredibly hard, even for companies with nearly unlimited cash. Just a few years ago, ByteDance spent $4 billion to acquire the studio Moonton, a clear signal it was going to war with the biggest names in gaming. Now, it's in advanced talks to sell that very same studio to Saudi Arabia's Savvy Games Group. This isn't a fire sale, it's a calculated retreat. And the asset they're selling is a certified giant. Moonton is the creator of Mobile Legends, Bang Bang, a game with a staggering 1.5 billion installations and over 110 million monthly active users. This is a crown jewel of mobile gaming, and ByteDance is walking away from it. So what's driving this? The buyer, Savvy Games Group, is a state-funded powerhouse on a global shopping spree. What's crucial to understand is that Savvy isn't just any investment firm. It's owned by Saudi Arabia's Public Investment Fund, or PIF. This is all part of the kingdom's Vision 2030 plan to diversify its economy away from oil. To do that, the PIF has set aside an astonishing $38 billion for Savvy just to invest in and acquire gaming companies. This isn't just a hobby, it's a national economic strategy. This acquisition follows its nearly $5 billion purchase of Scopely, signaling a massive power shift, and the prices being paid are reshaping the entire industry. Research shows that recent gaming acquisitions have valuation multiples far higher than the historical average, as sovereign wealth funds are often willing to pay a premium to secure these strategic assets. If that was just the appetizer, the main course is just being served. This isn't happening because ByteDance is in trouble. It's happening because ByteDance has become an absolute juggernaut. With a valuation soaring past $330 billion and revenues that have reportedly topped even Meta, the company is shedding a multi-billion-dollar asset to focus on its core social media empire. The move shows just how dominant ByteDance's core business has become so successful, it can turn a profit of billions by simply exiting a market it once planned to dominate. This isn't just a sale, it's a declaration of where the real power lies, as one tech titan sheds a gaming empire and a new state-backed giant rises to claim it. The implications of this are huge. With the purchases of Scopely and now Moonton, Savvy Games Group is on track to become the second largest mobile game publisher in the world, right behind China's Tencent. This raises new questions about IP consolidation and cultural influence, as a handful of powerful players, some state-backed, gain control over the games played by billions worldwide. That's a multi-billion-dollar deal reshaping the gaming landscape. But believe it or not, an even bigger financial shockwave worth hundreds of billions just hit the global property market, and the culprit wasn't a bad deal, but two letters, AI. A while back, we talked about software Armageddon, AI fears wiping out software valuations. That same logic just jumped the fence into commercial real estate services. Fears of AI disruption sparked a massive sell-off. On Wall Street, shares in property giant CBRE plunged 12.5%, Jones Lang LaSalle lost nearly 11%, and Cushman and Wakefield fell over 9%. The contagion spread to Europe, where major players like Savills and International Workplace Group saw their shares tumble. And what's so wild about this is that these aren't companies sitting on their hands. JLL has launched JLL GPT, and Cushman and Wakefield has an AI plus strategy. So investors are punishing these companies for a threat. They are actively trying to turn into an advantage. It's a fascinating contradiction, echoing the fear that if firms are just wrapping generic AI, the real value flows back to the model providers. This is the latest wave in a sell-off that has already hammered legal software, publishing, and insurance firms. The core fear is that AI is coming to automate high-fee jobs, making entire business models obsolete. The focus has now shifted to fee-based advisory work in property services, facing a similar repricing of value. What's unfolding is a massive split in the workforce. Research shows that roles involving repetitive, data-heavy tasks are the most vulnerable. For example, AI tools can now extract key details from a lease with over 95% accuracy. But on the other side of that divide are the senior deal makers whose jobs rely on strategy, negotiation, and human relationships. The situation presents a fascinating duality. On one side, AI is seen as a threat to office jobs, while on the other, it's creating an unprecedented boom in data centers. All this AI development requires massive power-hungry server farms. We're seeing traditional office construction fall to its lowest level in over a decade, while data center construction has absolutely exploded, tripling in just the last few years. So AI is both a destroyer and a creator of value in commercial real estate at the exact same time. But just as the panic reached a fever pitch, the biggest company at the center of the storm, CBRE, dropped a number that changes the entire story. While its stock was tanking, the company reported fourth quarter revenue of $11.6 billion, up 12%. What really brought this to a head was the firm's forecast for 2026 profits, which are actually above Wall Street estimates. So what's the real long-term view here? CBRE's chief executive, Bob Sulentic, believes the market has it all wrong. He went on the record to say that complex deal-making, which relies on creativity, strategic thinking, and deep relationships, is the most protected part of his business. And he's not just guessing. The key is that AI is fantastic at processing data. One firm found that using AI for initial deal screening cut the time it took from 45 minutes down to just 3. That's a 70% reduction in analyst workload. But when it comes to the final high-stakes negotiation, that's where AI stumbles. It lacks the intuition and creative problem solving that closes a billion-dollar deal. That human element is, for now, irreplaceable. His exact words, none of this seems likely to be replaced by AI in the foreseeable future. This sets up a massive showdown between Wall Street's AI panic and a corporate giant's on-the-ground reality. While investors are selling based on what AI could do, CBRE is betting its future on the one thing an algorithm can't replicate. So CBRE is betting on the irreplaceable human element in complex deals. But what happens when AI starts to learn the irreplaceable human touch itself? Our final story today is about just that a job that took a decade to master by hand is now being taught to a robot. This isn't science fiction. It's GE Aerospace's radical new plan to solve one of aviation's biggest crises. Right now, a massive backlog in jet engine repairs is idling planes. The pressure has turned into a public fight. For a company like GE, this is critical because the real money isn't just in selling new engines, it's in long-term maintenance. In fact, their commercial engines and services division recently pulled in nearly $9 billion in profit, almost all from services. Airlines complain that engine makers are benefiting, with AirAsia co-founder Tony Fernandez putting it bluntly, they've got to remember airlines are their future and treat us as partners. And you can understand their frustration. Services revenue for GE Aerospace grew by over 30% in a single year, highlighting just how lucrative this repair backlog is. GE's answer is a $300 million investment to upgrade its Singapore repair hub. The choice of Singapore is strategic. It has become a global hub for high-tech aerospace work with a skilled workforce and infrastructure to build a factory of the future. The goal is to use automation, AI, and so-called lean manufacturing to attack the bottleneck. Now, the truly innovative part is that they're applying assembly line principles to what has always been custom artisan level work. At one facility, they created a moving repair line that slashed turnaround time by a staggering 47%. The result? GE aims to increase repair volume by 33%, all without expanding its physical footprint. However, if you zoom out, you'll see another layer of strategy at play. By reorganizing floor space and automating tasks, the company says it can slash repair times in half. For one critical engine part, the turnaround time is targeted to drop from 40 days down to just 21. By meticulously mapping out every step, they found ways to cut lead time for some components from over 10 days down to just 3.5. The end game is to repair more used parts safely, freeing up scarce new components for brand new engines. It all comes back to teaching robots the human touch. And here's where it gets really interesting. They are automating tacit knowledge that feel a master technician has using robots with incredibly sensitive AI-driven force torque sensors. These sensors allow the robot to feel the resistance of the metal as it grinds, mimicking human touch. The level of precision they're achieving is almost unimaginable. to give you some perspective, a human hair is about 0.03 of an inch thick. The robot is working with a margin of error that is 30 times smaller. The company is capturing the skills of its most experienced technicians and turning it into a repeatable 24/7 process. GE CEO Larry Culp says the goal is to move away from firefighting and heroics. This high-tech overhaul is the company's bet to fix a critical weak point in the global supply chain.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.